Hi, Else here, and in this video, I'm going to introduce you to managerial accounting. Please consider downloading the worksheet that goes along with this video. It will help you to record the most critical information from the video so that you'll have notes from which to study from in the future. What is management accounting? Well, to better understand management accounting, it's a good idea to remind ourselves about financial accounting, which is likely a course you've already taken. The focus of financial accounting is the development and maintenance of the accounting information system. This information system collects, records, and organizes a business's activities. The product of any accounting information system is the financial statements. The financial statements tell a business's story, what it does, and how well it does it. They provide a business's financial performance, its current financial position, and its cash flows. External stakeholders use the financial statements to analyze a business and answer questions. This allows them to make decisions and meet their objectives. External stakeholders, also called users, may include shareholders deciding on whether to buy a company's shares or sell them. It could include government agencies such as Revenue Canada, who uses the financial statements to determine the company's income taxes. External stakeholders can also be the company's customers who purchase their products, or the creditors who loan the business money, or even society with regards to whether the business has ethical practices or what the business's impact is on the environment. There are other external stakeholders, but they are all outside the organization. Financial statements focus on reporting the company's history to their external stakeholders. It takes what has already happened and reports it in the form of the financial statements. Those external stakeholders, because they're making decisions about money, want the financial statements to be right. So the focus of the statements is on verifiability and precision. That's why financial statements are prepared using accounting standards, such as IFRS, which stands for International Financial Reporting Standards, or ASPE, Accounting Standards for Private Enterprises. External stakeholders also want the financial statements to represent the whole organization, everything that the business does. External stakeholders, when they make decisions about the organization, don't want to know about just one location for, say, Costco. They want to know the story of every single Costco location altogether. How does management accounting differ from financial accounting? Well, management accounting still uses the same accounting information system, but they use information from the system that is only available to internal stakeholders, such as employees and managers within the organization. These internal stakeholders use the information to make decisions about the future, decisions that will help the business meet their goals and increase the value of the organization moving forward. Management accounting might focus on the whole organization, but it might also look at individual locations or specific geographical locations. For management accounting, it's whatever is necessary to move the organization towards their goals. The emphasis in management accounting is on information that is timely for decision making and on information that is relevant for the decisions being made, whatever they might be. So, why focus on timely and relevant information? Because management accounting involves two different types of decisions. The first are strategic decisions. Strategic decisions focus on the entire business, and the goal is to set and implement policies that will move the business forward towards their long-term goals. Strategic decisions look at the company's resources, the threats that exist to the business, and what opportunities are available moving forward. And strategic decisions are, by their very nature, long-term. For instance, General Motors announced in 2018 that they would be closing their Oshawa car manufacturing facility. That facility was once the biggest auto assembly plant in the world, and in 2018 it had existed for over 100 years. However, As part of a global restructuring plan, General Motors announced in 2018 that by the end of 2019, the Oshawa facility would be closed. That's strategic decision making. So, what's the risk of strategic decision making? Well, the outcome of any strategic decision deals with the future, and the future, no matter how carefully a decision is made, can never be predicted with any degree of certainty. The second type of decision made by management accountants focuses on operational decisions, decisions about the day-to-day operations of the business. These decisions have to be in line with the company's strategic decisions. In fact, operational decisions often deal with putting strategic decisions into action, making them happen. Operational decisions are about how to get things done, and they are, by their very nature, more short term. So, if financial accounting is about reporting the past and management accounting is about predicting the future, does management accounting always ignore the past? Absolutely not. Management accounting uses information about the past to make decisions about the future, to try and predict the future and how changes might affect and improve the future. Both strategic decisions, such as whether to move production to another country in order to save on labor costs, and operational decisions, such as whether to keep or drop an existing product line, use historical information to help predict the future. All of this information is made available to internal stakeholders, such as employees and managers, to support them in their efforts to make decisions that will improve the business in the future. Thank you so much for watching this video, and I hope to see you in the next one.